If you're new to investing, the thought of picking a bunch of stocks seems overwhelming. How do you know which ones are good? How many should you pick? How much research do you need to do? All that confusion at the start makes you just want to go back on your couch, watch Netflix, and forget about investing.
It's not worth it! It's just not worth it!
But you don't need to pick a bunch of stocks to get started with investing. In fact, it's probably better that you don't do that until you get to a point to where your knowledge and skills are at a level to where you can do it well. Cool, so it's settled. Just sit back and wait to invest whenever you become a great stock picker, right?
No! God, please, no! No!
The most important part of investing is to start investing. Albert Einstein once said, "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." But see, what compound interest needs to actually work is time. So the earlier you start, the better. But you don't need to learn how to pick a bunch of stocks in order to do well. Investment companies have created investments that try to do most of the work for you to make it easy. And a lot of times, you only really have to pick one fund or one investment to get started. So in this video, we're going to go over 3 single investment funds that make it easy for beginners to start investing right now. Number 1, target date retirement funds. Target date retirement funds are investments that were created to make saving for retirement easy and hands-off for people who really don't want to manage their investments at all. How they work is that you pick a fund that lines up with your target year of retirement and adjust the risk level and exposure to stocks and bonds based on how far away from retirement you are. As you get closer to retirement, it rebalances the fund to theoretically become less risky over time. Once you hit retirement age, it's mostly bonds and very little stocks to provide you with a steady income. And all that happens without you really having to even do anything other than focusing on how to continue to contribute more and more money to it throughout the years. Let's look at the pros and cons so we can dig a little deeper on how they work. In terms of pros, number 1, it's an easy way to invest for retirement with a diversified portfolio. Number 2, automatically rebalancing to reduce risk over time as you get closer to retirement is great for people who don't want to or don't know how to deal with it. Number 3, they aim to even out the volatility by including exposure to bonds, even when retirement is decades away. Now there's a con to this, but the pro is that if you're worried about the value of your investment fluctuating, this helps to even that out. Number 4, it's available from most providers and there's a lot of options to choose from. So let's talk about some cons. Target date retirement funds can be too conservative for young investors. If you can stomach the volatility, having exposure to bonds probably doesn't make sense when retirement is 30 years away. Number 2, expense ratios vary widely by provider and type of fund. Number 3, it's focused on a retirement date, not your risk appetite or financial goals. If you want to retire early or create income streams while you're working, it doesn't really help do that. In terms of risks, one of the biggest risks with target date retirement funds is just making sure you pick one that has a reasonable expense ratio. You don't want your returns to get eaten up by high fees over the years, and you want a fund that uses index funds under the hood instead of actively managed funds. You can see, even though both of these funds look similar and say Fidelity Freedom 2050, the top one has an expense ratio that is 6 times the one on the bottom. And that's because the bottom one is composed of index funds while the top one is composed of actively managed funds. When you look at their performance though, they're almost identical, but you're paying more in fees for the top one. The next biggest risk for target date retirement funds is that they may be a little too conservative if you have a long investment horizon in front of you. You might argue that even having as little as 10% exposure to bonds when you have 30 years to retirement is probably a waste. In terms of options for target date retirement funds, there are plenty. Vanguard funds are some of the most popular out there. Here's a breakdown of the different ones that are available based on retirement date, risk level, and composition. Now basically, all the Vanguard retirement funds are built based on 4 index funds: a US stock market fund, an international stock market fund, a US bond fund, and an international bond fund. Basically what they do is they change the percentage allocation of each based on how far away you are from retirement. The further away you are, the more stock exposure you have. The closer you are to retirement, the more bond exposure you have. Just for another example, Fidelity is also a big provider of target date retirement funds, as you can see, but you can find these type of funds just about anywhere and just about with every provider. Just make sure that you're looking at the expense ratios and not overpaying for very similar performance. So who are target date retirement funds for? If you're looking to get started investing for retirement and you're okay with earning a little less as long as you don't really have to deal with it, target date retirement fund is probably the best thing for you. Obviously, there's investments that over the long term may perform better than target date retirement funds, but they're going to come with either more risk or more involvement on you. And if those are things that you don't want, then it might be the right choice for you. Number 2. Target allocation funds. Target allocation funds are similar to target date retirement funds in that they are made up of a combination of other funds to give you a diversified portfolio in one single investment. But the difference is that target allocation funds don't focus on a retirement year. They focus on your risk tolerance and your overall growth goals. Also, target allocation funds don't change the way that target retirement funds do. They keep the same relative levels and exposures to stock and bonds until you decide to change it. In general, target allocation funds go from the least risky funds that are aimed to give you income now to the most risky funds that are primarily made up of stocks for long-term growth. And what you'll see in these funds is a split in the exposure of stocks versus bonds depending on the risk level. So one end of the spectrum, which is the least risky and the most concentrated on income, you maybe only have 20% exposure to stocks and 80% exposure to bonds. Whereas on the other side of the spectrum, when the focus is on growth, you'll have more 80% exposure to stocks and only 20% exposure to bonds. So if you look at the breakdown in allocation from these Vanguard target allocation funds, you can see that on the income side, it's split 20-80, with 20% exposure to stocks and 80% exposure to bonds. It has the lowest risk level, but it also has the lowest 10-year return. Whereas if you go to the other side of the spectrum, where it's focused on growth, you see the breakdown is 80% stocks and 20% bonds. It's also the highest risk level out of all of them, but it also has the highest 10-year return. So in terms of pros, like target date retirement funds, target allocation funds are an easy way to get a diversified portfolio in one single investment. Number 2, it focuses on your target investment allocation and risk tolerance, not just a retirement year. So it accounts for your own individual goals and personality. In terms of cons, number 1, it does require some thought as to risk appetite and investment timeline, and that might be confusing to beginners. And number 2, just like target date retirement funds, expense ratios can vary widely and tend to be a little bit higher on average. Number 3, rebalancing and risk tolerance is left up to you, and that could lead people to taking on either too much risk as they get closer to retirement or not enough risk early on to where they don't get enough growth. In terms of risk, just like with target date retirement funds, you want to make sure your target allocation funds have a reasonable expense ratio. And secondly, I would say one of the main risks with target allocation funds is you have to know enough to be able to pick the right fund that matches your risk tolerance and your timeline. Not only that, but at some point you're going to have to look, reevaluate, and maybe rebalance into something less risky as you get closer to retirement. This really isn't a huge deal. I mean, you can just put something on the calendar once a year to be able to evaluate your portfolio and make a decision on if you want to change. But it is something that's more than you have to do with target date retirement funds, and you have to at least know enough to know when and what you want to do. In terms of option, Vanguard funds are some of the most popular out there. They tend to have lower expense ratios, obviously because they're built up of index funds, but there's also great options from Fidelity, Schwab, and most other investment companies. So who are target allocation funds for? Target allocation funds are really great for people who still want a diversified portfolio in one single fund, but want a little bit more control and flexibility than a target date retirement fund can give them. With target allocation funds, you can choose one that fits your risk level and your aggressiveness without having to choose a whole portfolio for yourself. Number 3, the S&P 500 Index. Believe it or not, my favorite single fund portfolio is just the S&P 500 Index. This is something that we've invested in for a very long time. My wife's retirement account is still only invested in the S&P 500 Index right now. In 2017, Warren Buffett said,
I think it's the same thing that makes most sense practically all of the time. And that is to consistently buy an S&P 500 low-cost index fund, keep buying it through thick and thin, and especially through thin.
But why is that? What is it? The S&P 500 Index is a list of 500 American companies that meet the quality criteria that's laid out by Standard & Poor's, which is where the S&P comes from. But to oversimplify what that means, investing in the S&P 500 Index is basically investing in the American economy. Historically, that has been a very good bet, and it has seen returns that outpace those of just about all target date retirement and target asset allocation funds. The reason for that is that stocks have been very good over the past 30 plus years, and US stocks especially. So the flip side of this is that the returns on the S&P 500 tend to fluctuate a lot. So you have to be okay with losing 20 to 30% of your value in a given year and not freaking out. But if you have a long-term investment horizon, it's hard to go wrong with just investing in the S&P 500 index like Vanguard's VOO ETF. It has low expense ratio and has historically performed extremely well over time. In terms of some basic stats, if we look at Vanguard's S&P 500 Index ETF, VOO, you see that it has an extremely low expense ratio of 0.03%, has a risk level of 4, and a 10-year return of 12.76%, which is pretty excellent. In terms of pros, number 1, has a strong history of returns. 2, very low expense ratios that keep costs down. Number 3, betting on the American economy over the past 100 years is one of the best and safest bets you could have made. And then number 4, one of the best investors ever to live, Warren Buffett, basically recommends this as the path for most people. In terms of cons, the S&P 500 index is going to be more risky and volatile than the other options that we've talked about because it's 100% stocks. And number 2, even though it is diversified in terms of a broad base of US companies in different industries, there's no international exposure or bond exposure, so you're betting on the continued strength of the American economy and American companies. In terms of risk, the biggest risk with the S&P 500 index is you have to be prepared for it to go up and down without panicking. Because it's 100% stocks, it's going to be more volatile than a well-diversified portfolio fund. But that volatility has also meant increased return over the years, as long as you're able to hold through it. Other than that, I would say a risk is that if you're closer to retirement and you're at that stage where you need your investments to be able to provide steady income, S&P 500 index is probably not the best place to put it, at least the majority of your funds, because again, the volatility can make it go up and down, and if you need that money relatively soon, probably not the best choice. It's really for people who have a long-term investment horizon. So who is the S&P 500 index for? To be honest, I think the S&P 500 index is for just about everybody, and everybody should have at least a small portion of their portfolio invested in it. And if you believe in the strength of the American economy over the long term, and you're okay with your value fluctuating 20 to 30% and not really worrying about it, the S&P 500 index could literally be your only investment, and you'd probably do pretty well over the long term. And this is exactly why Warren Buffett said it's probably what most people should be doing if they don't want to learn how to evaluate stocks. When people ask me how they can get started, it's usually the first thing I have them look into. Okay, so I know I said 3, but let's talk about a bonus one for you guys. Let's talk about the Schwab US Dividend Equity ETF. The Schwab US Dividend Equity ETF is one of the best dividend ETFs out there, and in my opinion works very well as a single fund portfolio for people who are trying to build up a dividend income. While saving for retirement is something that everyone should do, building up a dividend portfolio in a taxable brokerage account is one of the best ways to create a passive income stream that can help you complement the income from your job. I've talked about how this was my biggest regret in my corporate career. I spent so much time trying to save for retirement that I didn't build up a dividend portfolio the way that I should have. And that would have made the transition out of my corporate job so much easier. So if you don't think you're going to be working your 9-to-5 job all the way up to retirement, building a dividend portfolio is something that you should strongly consider. Okay, let's take a look at the stats. SCHD is an ETF that mimics the Dow Jones US Dividend 100 Index, which is 100 stocks that have paid dividends for at least 10 consecutive years. It currently has an expense ratio of 0.06, so about $6 for every $10,000 invested, which is pretty cheap. It has a dividend yield of 3.37%, and if you compare it to the S&P 500, it has actually slightly outperformed the S&P 500 over the past 10 years, but it's pretty close. So in terms of pros, number 1, it's actually outperformed the S&P 500 index over the last 10 years. Number 2, the dividend focus builds an income stream if that's what you're looking for. Number 3, it's slightly less risky than the broader market since the focus is on established dividend-paying companies. In terms of cons, number 1, because it focuses on dividend-paying companies, you can miss out on high-growth companies that will exist in the S&P 500 and in the NASDAQ. Number 2, dividends have tax implications if you're not in a retirement account, so if you're receiving those dividends in a taxable account, you'll have to pay income tax on them. And then number 3, even though it's diversified in terms of 100 US companies, it's not diversified in terms of international exposure or bond exposure. In terms of risks, I would say the biggest one is that out of all the options that we've talked about in this video, this one is the least diversified. It's literally 100 US companies that pay dividends. And then number two, there's always a chance that a prolonged recession will start to hit the companies that are in this fund and impact the dividends that you're getting. But one of the great things about this ETF that I like is that even though solid companies that pay dividends aren't always the hottest thing in the market to buy, they're usually one of the most consistent. And so when you're looking to build a steady income that you can use to complement your 9-to-5 job, that's a really good thing. When you're just starting to invest, having to decide what to actually invest in can be a little overwhelming. Hopefully these single fund options can make it easier for you to get started and allow you to begin building up your nest egg even while you're still learning. If you want to dive deeper into building a dividend portfolio to be able to create steady passive income, click on this video right here where I talk about the top 4 monthly dividend stocks right now that are undervalued and will make a great addition to your portfolio. Thanks for watching. Hope you guys have a great day out there. Keep stacking those wins for your family, and I'll see you guys in the next one. Take care. Peace.